The epic tug-of-war between home buyers and sellers rages on, with mortgage rates soaring to a staggering 7%. Here we go again, folks. Halfway through the year and it feels like deja vu. Every conversation I have with home buyers and sellers, it always revolves around those pesky mortgage rates. And rightfully so. With their recent volatility, they're causing quite the emotional roller coaster in the housing market. As someone who interacts with buyers and sellers daily, I've seen this drama unfold firsthand. When rates dip near 6%, homes are gobbled up in a frenzy with multiple offers above asking price. If you're showing a house to a client 4 days after it's been listed, you're probably too late. And to top it all off, listing agents go full-on ghost mode. It's like 2021 all over again. But when rates creep close to 7%, the mood shifts dramatically. It's not to say that it's a full-blown buyer's market, but higher rates mean homes linger on the market for longer and buyers enjoy more favorable terms and incentives. And this is where we find ourselves today. What's going on, guys? It's Vitaly, and in today's video, we are going to dive into the housing market of 2023 and exploring the impact of mortgage rates on both buyers and sellers. Plus, we'll be hitting the streets to get the public's opinion on the current mortgage rates and housing market situation. So don't go anywhere, stick around. As mentioned earlier, mortgage rates are currently hovering around 7%, the highest level we've seen since early March. Now, you might be scratching your head wondering why rates are on the rise. After all, didn't Democrats and Republicans recently reach an agreement on the debt ceiling, effectively avoiding a debt default and recession? Shouldn't this positive development give us a break on the mortgage rates? Unfortunately, that's not the case. While it's undoubtedly good news that we are averting a default, it also means fewer chances for a recession. This in turn allows the Fed to keep rates elevated for a more extended period, as opposed to cutting them as they typically would during a recession. Moreover, some experts now predicting that the Fed might even raise rates even farther. In fact, traders of future contracts estimate a 60% chance that the Fed will boost its target range for the benchmark rate by another 25 basis points. Back in May, though, the outlook was quite different. Traders were betting on an 83% probability that the Fed would postpone raising rates in June. Market participants thought that the turbulence in the banking sector might prompt the Fed to adopt a more cautious approach and steer clear of over-tightening. However, then came Neil Kashkari and completely flipped the tables during a CNBC interview, effectively crushing any remaining hope in the markets. Let's take a look at what he had to say.
But Neil, you're a voting member. If you had to vote today, how would you vote?
Well, it's a tough thing. It's the reason we vote every 6 weeks or so. I think right now it's a close call either way versus raising another time in June or skipping. Some of my colleagues have talked about skipping. Important to me is not signaling that we're done. If we were to skip in June, that does not mean we're done with our tightening cycle. It means to me we're getting more information. Do we then start raising again in July, potentially? And so that's the most important thing to me, is that we're not taking it off the table.
So the Fed intends to avoid sending mixed signals due to their concern that the market might perceive their tightening policy as complete, particularly as inflation remains above their 2% target. The latest inflation data has dampened any optimism within the Fed, leading to discussions about whether they should implement an 11th rate increase in June. The key price index, closely monitored by the Federal Reserve, revealed 0.4% increase in prices from March to April, which is significantly higher than the 0.1% rise observed in previous month. Year-over-year prices in April rose by 4.4%, up from 4.2% in March. This increase in prices is primarily driven by consumer spending. In April, consumer spending, acting as the main engine of economic growth, increased by 0.8%. This is a substantial increase from the 0.1% growth recorded in both February and March. Consumer spending was fueled by strong job growth and wage increases. The current unemployment rate still remains at historically low 3.7%, which is not ideal for the Fed when inflation is running hot. The Fed would prefer the unemployment rate to be closer to 4.5%. Reaching that level, unfortunately, will require more people to lose their jobs, as harsh as it sounds. Experts predict the unemployment rate will reach 4.6% by the end of 2023, indicating that we may see more job losses in the future. You can see how everything is connected, and one affects the other. When people have stable jobs and income, they tend to spend more. This increased spending leads to higher prices, which in turn results in elevated inflation. To address this issue, the Fed raises interest rates, making borrowing more expensive. In theory, this should discourage consumer spending and help slow down inflation. However, recent trends suggest otherwise. Americans just can't resist the urge to spend, even if it means maxing out their credit cards. That's right, folks. A recent report reveals that Americans are swimming in nearly $1 trillion worth of credit card debt. And if that's not jaw-dropping enough, the average interest rate on these cards has now soared past the 20% mark, setting an all-time high. Since April 2021, credit card debt has skyrocketed by a whopping $250 billion. As of the end of 2022, Experian reports that the average account balance is teetering at around $6,000. So, folks are still spending like there's no tomorrow despite soaring prices and interest rates. It makes you wonder if people have stopped caring thinking about higher rates as long as credit enables them to snag that dream car or home. This is something I've noticed lately while chatting with home buyers and sellers. It seems like they've developed a tolerance for higher rates. I'm not implying that they're completely nonchalant, but the sentiment has certainly shifted since mortgage rates first hit 7% back in October 2022. At that time, it felt like the world was ending. The market crawled at a snail's pace compared to today. Of course, seasonality played a part in the slowdown. The housing market always chills out during winter, but it still felt like the market was on a downward spiral. These days, it appears that people just shrug off higher rates. They may not be thrilled about them, but they accept this new reality and are determined to make it work, diving into the market with the hopes of refinancing someday. Instead of going off of what we feel like people feel like, we decided to hit the streets and ask people directly about their thoughts on today's mortgage rates and housing market. Here are a few snippets of what they had to say. How's it going, ma'am? Would you be willing to participate in a quick real estate survey? 3 questions.
What kind of a survey?
What do you think of today's mortgage rates?
They're too high.
Too high? Are you more concerned about higher prices or higher mortgage rates?
Good question.
Yeah.
Both.
Both, yeah. Would you buy in today's market?
No.
No.
Because we were thinking about moving, but we decided not to because our interest is so low.
Yeah. What are you at right now?
I think it's like 3.2 or something.
Jeez. Yep. It's 7% right now.
I know. And
Yeah.
so forget it.
What do you think of today's mortgage rates?
I'm actually not in the market to buy a house right now, so
Totally.
I'm not
Yeah.
entirely aware of what's going on. But
So
I
right-
know that the housing market is absolutely ridiculous.
Yeah. Would you buy in today's market?
No,
No?
no, not at all.
Not at, when are
No.
you going to buy then? When it's going to crash like 2008 or?
Honestly, I have no idea.
Yeah.
I'm just I'm more of the person that just kind of flies by the seat of my pants.
3 questions.
Okay.
What do you think of today's mortgage rates?
I think they're horrendous.
Horrendous.
Mm-hmm.
Yeah. Are you more concerned about higher prices or higher mortgage rates?
Higher prices right now.
Higher prices.
Yeah.
So if the prices were right, would you still buy a house at 7%, which is what the rates are right now at?
Possibly.
Yeah.
Yeah.
Do you own?
I rent right now.
You rent right now.
Yeah.
Rents are not any better, right?
No, they're not.
Yeah.
I could be mortgaging.
So you're more concerned about higher prices instead of higher mortgages because I'm assuming you can always refinance later, right?
Right.
Yeah.
I don't know. I pay cash for my house.
Get your money up, not your funny up.
I love it. Would you say if you were to buy financing, would you be more concerned about higher rates or higher prices?
Well, higher rates mean higher prices.
That's
So,
true. Yeah. Would you buy in today's market? It sounds like you already have a house. But...
no, I have a house and pay cash for it, so no.
So no mortgage on it?
Right.
Nothing. I love it. That's all we wanted to know. By the way, you can find a link to the full video in the description below. As seen in the video, we received very mixed feedback. Still, most people expressed deep concern about today's housing market. Some said there's no way they would buy today even if they could, while others said they would purchase regardless of the interest rate as long as the price is right. Another interesting feedback we received from people we talked to, particularly from those who currently own a house under a historically low rate of anywhere between 2.5% to 3.5%. This group of people said they would prefer to stay put instead of selling their house and giving up their low rates. Which leads me to my next point. I believe this is where the fundamental problem lies. Higher mortgage rates indeed have slowing effect on the housing market by making it more expensive for buyers to purchase a home, which in theory should result in decreased buyer demand. However, these increased mortgage rates have unintended consequences as they also affect home buyers by making them less likely to sell their properties. This then decreases the available housing inventory, further driving up prices and making it even harder for buyers to purchase a home. As you can see, increased mortgage rates have created a vicious cycle in today's housing market, as we are still dealing with insanely low housing inventory, or as my friend from Housing Wire, Logan Motoshami, likes to say, savagely unhealthy market. That's it for today, guys. If you enjoyed watching our stuff, please make sure to like and subscribe. Stay safe and stay informed. I'll see you on the next one.